silver with a target at 333. And inside of that, we have single-digit gold-silver ratio. There is so much more to come. And where did this strength come from? Well, we have a divergence in the price. Let's talk fundamentals. You have a divergence in the price between China and between the casino, not so big on delivery market, versus the delivery market in Shanghai. So that tells you one thing. You have a huge amount of JP Morgan covering at $78 near the low. That tells you a whole bunch of stuff as well. Bearish for the gold-silver ratio, friends, is good for you. This is rounded dome and back down for me. It's rounded dome. I'm not saying in one go you're just going to run it though. I think you could do this, and you might still respect the 50 level a little longer. So that's why it's not all, hey, moon, just nothing but surge pumpamental. You're broadly going to make your way up steadily with some setbacks, small winding up structures. We waited for gold. We went heavier on gold first. Gold tends to leave, but silver tends to overperform. So let me say that again. Gold tends to lead, silver tends to overperform. So after an event such as this, gold on this time frame is actually slightly better.
Silver's bullish case is strengthening, with analysts pointing to a long-term target near $333 and the possibility of a single-digit gold-silver ratio ahead. According to Francis Hunt, structural divergences between Western paper markets and the physical delivery market in Shanghai signal growing stress beneath the surface. Heavy JP Morgan short covering near $78 adds fuel, suggesting smart money positioning for higher prices. While gold typically leads major moves, silver historically overperforms in later stages, climbing faster as momentum builds. The projected path isn't a straight line. Expect pullbacks and consolidation, but the broader trend remains firmly upward for silver relative to gold. Now, we present the clips from Francis Hunt's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
Where would the target be? Well, let's have a look. Let's have a look for you and draw the next target level. By the way, you can see that blue line. I'm sure you know what that is. That is, of course, there's your 85. We do necklines in light blue and solid. There you go. That would be your neckline. And what would you do? You'd do a projection. You'd make sure, go away. There we go. You'd do this from the low up to, that'll be your target once you get going with a bit of speed. By the way, this part from here to here was covered with momentum. So you can understand, again, continuation patterns when you're in the downside. There's many of them on that period during the way down. Sure as that will happen. Again, there's your reversal, shoulder and shoulder. Final neckline, complex head with a W, and there's your other armpit, 1 and 2. So you are in a winding up, calm state for which you've just broken up out of a falling wedge, and you are chill, but getting ready to move further forward. On balance of probabilities, how do we be wrong? The point which we're wrong is the right shoulder, and it can absolutely happen, and we will take losses. It's as simple as that. So you must know the size of your losses. For that, you need a real money management, and you need to have a broker that shows you those losses. It's even better when it shows you on TradingView. I can see and manage all that, the sum of all those losses, or how much I'm in for. So overall, we think we're going to pop out the top of this and make our way up to 98, which probably means a technical run back above 100. Technical run back above 100, and then you could be in line for a further head and shoulder maybe. If you run that 100, do 104, do a shoulder. This will all be a new head, one big head, and you could continue to work your way back up on what we refer to as nestled heads and shoulders. Okay. That's quite a lot that I've given you to absorb on gold and silver. The other point I want to make that I was also making to our premium guys earlier, and the key thing is when you get the news, is you'd made 50 on the downside of, let's go back up, you always start on the macro, you'd made 50 on the downside of the gold-silver ratio. You'd smashed a key level there that we put in there in the dashed blue line. You came all the way back up, and now you're going to dribble your way back down. It may take longer for us to get up that head of steam where it gets to that point just before the last rejection. Remember, we started slow. You got spoiled near the end. It was too good. It was coming too fast. You got a tiny bit spoiled. You may need the gold-silver ratio a couple of times to come down here before you let go and we start making new numbers. That could happen, for example. It's a key level. You're up at 107 over here, and you've been as high as nearly 100 through 128. So this isn't going to happen just because you want it to happen in a hurry again. It takes a while to build up that level of momentum. It has to become obvious again. There's a lot of people that think that's it, that's the top. A lot of people think you're not going to see a new high until 2030 on silver and all sorts of things. Good old Peter Brunt and anybody else. Lots of other people with their views. And it's okay to have views. It's not right or wrong. And for all we know, we'll be proven wrong. But on balance of probabilities, this candle will come back down at least one more time. It might bounce around before it's allowed to go down to 32 and eventually single digits. But single digits is where we will get out.
Technical analysis suggests silver is building toward higher targets, not collapsing. Chart structures show a completed complex head and shoulders reversal, breaking from a long wedge into a calm consolidation phase before acceleration. Using neckline projections, analysts point to an initial move toward $98, followed by a likely technical run above $100. From there, nested continuation patterns could drive further upside. The gold-silver ratio, having already fallen sharply, is expected to grind lower again, possibly after multiple retests, before a decisive breakdown. Momentum takes time to rebuild, but on balance of probabilities, silver advances while the ratio trends toward eventual single digits, where long-term exits are planned. Let's get back to the interview.
We're going to jump right down from daily to weekly, and I'm going to share this again. Now, on this particular broker, they've cut the time a little bit in an interesting space. It's not quite a hammer that, but in actual fact, depending on who you get, let's try TVC. Let's go back to our friend Tickers. Yeah, depending on this one, and you'll note that I'm using weighted candles, and some of you will go, the volume, Francis, the volume. You always tell us volume matters. Yes, it does indeed matter. That was a big volume day, but this was equally big. The fatness of that candle is actually slightly fatter than that one. And this was already thinning, and those are complete days. Now look at the hammer's width down here on this broker, and it depends where you've cut it. You can see our early entries here, over here, the blue lines all along, all the way through, and we've added a few literally there. We're having a tiny bit of a pullback. So we're looking at this on a daily time frame. So we've already shown you monthly, fortnightly, weekly. We're now going daily. We're looking at the same data broadly, different brokers cutting it at different times. It's the same numbers. The high should be around 5,600 over here, and the low for gold should be around 4,000. Let's get you an exact number. Tickmill says 4,402 was the low, and the high was 5,597 and 5,596. So almost 5,600 and 4,4, the low. So 5,600 and 4,4. Quite a move, I'll say that much. So that's $1,200. $1,200. Let's also get a percentage on that because silver was even more extreme. But let's just catch up and do the numbers for you to the low. 21.35%. For gold to do that level of move in the space of 3-4 days is unheralded and points to an organized attack, because the dollar didn't suddenly become more investable. The banks aren't suddenly more better fortified by balance sheet and safer and in a better way. Everything continues to get worse, and you are in a debt fiat-based collapse. Okay, so this was an orchestrated move by the forces that needed to do whatever they needed to do, and they've actually given you a gift. Remember, you can get angry or you can laugh and say that's a great gift. If you got out with us, this has been a great gift. I'm going to make the same territory again and make profit on the same territory again, having already done so previously. And when it gets up to where it was, I'll have profited twice from this area here up to here. How nice is that? They're giving you a do-over. They're literally giving you a do-over. And you'll still not end up at a higher up number. If you get just back up to here, you get a full do-over. Thank you very much. The criminals that are actually captured by their fraudulent practices are having to do certain things. And I can tell you, it's proven very beneficial. Just from last night, that's 216 grand. That is 30. That is, I mean, these amounts, they're not realized. They mean nothing. I've got some stops that are no longer here. I don't even have stops here anymore. We've dropped time frames. We've found patterns on lower time frames. I've already trailed my risk up to the very lowest points over here, to others over here, to others over here. These latest entries have quite aggressive stops on them because I went big. 50, go and prove if I'm right, trade on up. If I'm wrong, I'm out quickly and I eat my loss and I wipe my mouth and I say, okay, a bit too greedy maybe. Why did we do that? Let's go and have a look. Let's go and have a look. What's going on the 4-hour time frame? I'm going through typical time frames that we tend to utilize. So let's show you this. Let's clean our face and you'll get an idea of why it was interesting to us.
A deep dive from weekly to daily charts shows why gold's sharp pullback looks less like panic and more like precision. A $1,200 move, nearly 21% in just days, is historically rare for gold and strongly suggests an orchestrated event, not a sudden improvement in the dollar or banking system. Volume-weighted candles and broker-to-broker variations still tell the same story. Structure remains intact. For disciplined traders, this drop represents a do-over opportunity, allowing profits to be made twice in the same range. With risk actively managed across lower time frames, the broader thesis remains unchanged. Fiat debt stress is growing, and gold's trend is far from over. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.